Greetings. Thank you for joining today's webinar, Cutting Through the Chaos, Off the Beaten Track, 6 Not So Obvious Planning Ideas. I'm Lee Basha from Washington, D.C., and I'm here to moderate today's excellent panel session. In case you have questions, they can be submitted through the question and answer function on the Zoom, the Q&A function. And today's PowerPoint presentation slides will be distributed after the webinar concludes. If you are requesting CLE credit in New York, please listen at the end of our presentation for the validation code needed to obtain CLE credit. We all know Thomas Edison and Elon Musk are clever individuals. Have you ever seen the Tesla share price this week? Well, I am happy to say so are my partners, Carlin McCaffrey, Dick Lang, and Tim Halloran. Today, they are going to share 6 astute strategies for planning for the high net worth client. These techniques may prove more effective in some instances than traditional estate planning techniques. Some need to be implemented before year end, so there is no time to waste, and we will get started. Tim, please kick us off with the non-charitable purpose trust.
Thank you, Lee, and thanks everybody for joining us today. Carlin, Dick, and I are thrilled to join you and lead this presentation. I'll lead off with a few minutes on the use of purpose trusts and discuss a few interesting uses for those trusts, and then we'll move into some tax planning topics. Outside of wholly charitable trusts, a valid trust historically had 3 requirements. It had to have a trustee, it had to have a trust corpus, and the trust had to be held for the benefit of one or more individuals who are the trust beneficiaries. The trustee would handle the trust administration, and the beneficiaries would hold the trustee responsible. And the thought being that the trustee who was not accountable and didn't have to answer to anyone wasn't really acting as much of a fiduciary. The beneficiaries could enforce the trust and take appropriate action against the trustee in the event of a breach, holding the trustee responsible when any losses occurred. Wholly charitable trusts are purpose trusts held for one or more charitable purposes. Those types of purpose trusts have been held valid for hundreds of years, and consistent with the concept that a trustee should be held accountable, state attorneys general are authorized to enforce those charitable trusts. We go to slide 5. Since the 1990s, a number of states have adopted statutes permitting the creation of these trusts to accomplish one or more non-charitable purposes. With a purpose trust, there are no beneficiaries in the traditional sense. A protector or enforcer is appointed pursuant to the terms of the trust instrument to enforce the terms of the trust. And the trust provides for one or more valid purposes, none of which can be contrary to public policy. Although individuals are not designated as direct beneficiaries of these trusts, the administration of a purpose trust can often provide indirect benefits to one or more individuals. For example, a purpose trust can hold a family compound and can provide for use of the compound by family members at the trustee's discretion. The trustee would be responsible for all aspects of management, scheduling, and upkeep with respect to the foundation. And while the family members may be permitted to use the property, the trustee really wouldn't have any fiduciary duties to those family members. One reason a grantor might do this is to retain the property as a family compound instead of worrying about family members pressuring the trustee to sell the property at some point. The Uniform Probate Code and the Uniform Trust Code both include provisions for purpose trusts, including trusts for the care of animals, or pet trusts as they're commonly called. About 40 states have adopted some form of purpose trust statute, including Illinois, which adopted a purpose trust statute when it enacted its version of the Uniform Trust Code earlier this year, so effective January 1, 2020. When adopting these statutes, states generally vary the language of their purpose trust statute by modifying the common law rule against perpetuities limitation, allowing for perhaps greater flexibility in appointing a trust protector or trust enforcer, expanding or narrowing the scope of permissible non-charitable purposes, and varying the degree of judicial oversight that's required. As with many modern trust provisions, purpose trust statutes have become another competitive edge for leading trust jurisdictions. Most enacting states limit the duration of a purpose trust to 21 years, which is consistent with the Uniform Trust Code provision. So if a longer duration is important to achieving a client's planning goals, you may have to look to a situs or to situs the purpose trust in a favorable jurisdiction. For example, Delaware, New Hampshire, South Dakota, and Wyoming all provide for perpetual purpose trusts, and other states provide for terms longer than 21 years. Nevada, for example, provides for a 365-year purpose trust, and Tennessee allows for a 90-year purpose trust. Purpose trusts can be created for any valid purpose. Some typical examples include trusts that are created to own and maintain assets of significant importance and perhaps significant value to the client. Those assets might include wine, artwork, various collections, firearms, or residential property intended to be used by multiple family members for generations. Other purposes that a trust might validly serve could include owning interests in an operating business, providing a social statement, owning the interests of a private trust company, or serving as the member of a not-for-profit corporation created as a membership organization. So let's take a closer look at some of those examples. One recent use of a purpose trust to own a business is in the case of this company called Organically Grown Company. It's an agriculture business located in Oregon. In 2018, the company ownership was transitioned from an ESOP to a perpetual purpose trust. The company viewed this type of ownership as a model to support purpose-based entrepreneurship, ownership, and succession. The trust ownership was intended to relieve the pressure to maximize short-term quarterly profits and exit value for shareholders, and instead allow the company to focus on maximizing what it believed to be its true purpose, to improve health through expanding organic agriculture. The stakeholders in the company are involved in the purpose trust administration, and they are authorized through the trust instrument to elect the trust protector committee. So this is balance of interests. A purpose trust also could be considered for the ownership of just the voting stock of a company, with the non-voting equity owned by family members or trust for their benefit. The next item is a purpose trust created to provide a social statement, which is again another valid purpose for a purpose trust. In this case, the Reparations Purpose Trust is a Delaware perpetual trust created in 2016 that owns shares of a publicly traded insurance company. This purpose trust provides that the trust won't terminate until the U.S. government takes action to provide for reparations for slavery. Upon termination, the shares will be sold and the proceeds will be distributed to the acting government agency. The purpose trust instrument itself is an item of artwork that's been exhibited in a number of galleries and museums. We typically provide for private trust companies to be owned by irrevocable trusts that are intended to lock in certain tax benefits of the planning. Oftentimes, these trusts do have beneficiaries, but the purpose trust could also be used in this context and could be created for the purpose of owning and controlling these private trust company ownership interests without the need to account to beneficiaries or other family members. And then the same reasoning could apply to other family entities that aren't really intended to throw off significant value, but instead serve an important administrative role for the family. If we go to slide 11, Hallie. Thank you. One of the main risks the client faces in creating a significant charitable foundation is that the foundation managers won't adhere to the client's wishes after the client is gone. So a public conflict along these lines broke out in recent years with respect to the Surdna Foundation, which is a $1 billion foundation created by John Emery Andrus, who died in 1934. The disagreement stemmed from whether the foundation's board was furthering Andrus's charitable goals or whether the board had deviated from its philanthropic mission. Since Andrus died in 1934, we're not going to be able to ask him what he wanted, but there may be steps that clients can take to ensure that their charitable mission is sustained and their charitable goals are achieved. Assume a client's formed a significant charitable foundation that's intended to support specific purposes. The foundation is formed as a membership nonprofit corporation. The client is the sole member, and the client retains the right to designate successor members. The member of the foundation can elect the board, so the member has significant control over the foundation's mission. The grantor might consider creating a purpose trust to serve as the sole member of the foundation when the grantor is no longer acting as the member. The foundation's bylaws could provide that the foundation's purpose and governance provisions can only be changed with the approval of the member, being the trustee of the purpose trust. And the purpose trust could contain provisions requiring the trustee to adhere to the client's intended charitable purposes. Also, the purpose trust could include a timeline for distributions so that the foundation is spent down in a reasonable amount of time in furtherance of the client's charitable goals, instead of being left to a board of directors or managers who might deviate from the charitable purposes intended by the client. Thank you, and I think we'll move on to Carlin's first slides. I think, Carlin, you're on mute.
Hello, everybody. I'd like to add my thanks for joining. We're going to talk about 6163. 6163, first slide, please, is a sleeper provision that probably saw a lot more use decades ago when it was common to create trusts that would pay income to a beneficiary for a term and then revert back to the grantor, so-called Clifford Trust. If a grantor died during the term, the reversion would be included in the gross estate, but the estate could not get at the assets until the term interest ended. So 6163 was a way to allow the estate tax attributable to that reversion to be deferred until the assets became available to pay the estate tax. Clifford trusts are long gone, but 6163 is still in the code, and if the requirements for its use are met, it allows an estate to defer the payment of the estate tax and, importantly, defer the payment of the interest that accrues on the deferred estate tax until the interest preceding the reversion or the remainder expire. Just next slide. Just to quickly review for anyone not familiar with this terminology, a remainder is the future interest in a property that follows all term or life interest. For example, wife funds a trust to pay income to a child for 30 years, remainder to husband. A reversion is a name used for a remainder that reverts to the donor. For example, husband funds the trust to pay an annuity to child for 30 years, reversion to the husband. In addition to the requirement that the remainder or reversion be included in the decedent's gross estate, 6163 is available only if the reversion or remainder was created before the decedent's death. In other words, the decedent's will can't set up a trust to qualify for the deferral. But it's perfectly okay for the decedent to queue this deferral up with transfers before death. A couple of other points here. The amount of the estate tax deferred is based on the ratio of the value of the remainder or reversion to the value of the gross estate. The deferral is elective, so it's going to be up to the executor to elect it. And the IRS has the authority to require the estate to post a bond for the unpaid tax and interest. So here is why 6163 is so interesting. Interest on the deferred estate tax is deductible from the gross estate as of the due date of the tax, resulting in a retroactive reduction in the estate tax. For example, $1 of interest accruing in year 10 is treated as paid when the tax was due. A payment with a future value of $0.10 is treated as $1 of deduction. The result is a circle of ever diminishing estate tax and ever increasing interest, but the total of tax and interest never exceeds the original estate tax value of the remainder or the reversion. Meanwhile, the growth on the government's money inures to the benefit of the trust which has the effect of diminishing the effective estate tax rate. The interest rate that applies is the IRS underpayment rate you may be familiar with. That's the 3% plus the federal short-term rate, and right now the federal short-term rate rounds down to 0, so it's a 3% interest rate. Let's take a look at an example to see how this works. Take a remainder worth $10 million at death and assume that the estate tax and interest will not be due for 30 years. The estate tax that's otherwise due is $4 million. Under 6163, applying today's underpayment rate of 3%, in 30 years, that $4 million estate tax and accrued interest will have grown to only $6.18 million, reflecting an internal compound rate over that time of only 1.46%. To which you reply, interest rates eventually will increase. Of course. Well, in that case, even if applicable interest rate were 10% over that entire period, the amount due, tax and interest, would be $9.21 million, reflecting only a 2.82% internal compound rate. One would hope that normal investment returns should far outstrip these low interest rates, especially over long periods of time. Now, this next slide lays out the same and some additional data in tabular form. You see that the total pay, interest, and tax at the end of the deferral never exceeds the estate tax value of the reversion. And even if the interest rate imposed is high, look at the 10% column, it's the ability to deduct that interest accrual as of the tax due date that results in only a modest interest cost. So to me, this was tempting to figure out how to plan into 6163 in order to obtain long-term, low-cost financing from the government while we put off the estate tax or payment of the estate tax for decades. And this may be particularly tantalizing with, say, hard-to-value assets, where the battle over a payment that's going to be due 30 years from now just may not be worth it to the IRS to fight today. So let's take a look at a couple of ways we may engineer ourselves into 6163. So in this first example, shortly before death, wife creates a 30-year, what I'm calling NCLAT, a non-charitable lead annuity trust for her children, retaining the reversion. Wife is going to pay gift tax, and her estate is going to pay estate tax on the gift tax incurred to create a small upfront annuity interest. The trust reversion is included in wife's estate. Wife's executor elects 6163, and the estate tax and interest is deferred for 30 years. And the results you see in the chart here, and it's presented on a present value basis. When we take into account growth over 30 years at the indicated rate and reduce that by the modest hurdle rate of interest on the deferred tax that we discussed a moment ago, there is a significant positive benefit that is expressed here in present value terms as a reduction in the effective estate tax rate. So instead of a 40% estate tax rate, the net benefit of the deferral might end up having the estate tax rate. You see that on the far right, where the interest payable accrues at 5% and the investments grow at 10% per year. But look at the result on the far left. Even if you pay interest at 10% and earn only 5%, the effective estate tax rate is dropping by 20%. If you study this, you'll see that it's more about what you can earn on the deferred dollars than what the interest rate is being charged. In the second construct, the results may be even better. Shortly before wife's death, husband creates a trust providing all the income be paid to the couple's children for 30 years, remainder to wife. Gift tax is imposed on the income interest, but the remainder qualifies for the gift tax marital deduction. Wife dies, the reversion is included in her estate, and wife's executor elects 6163, and the estate tax and interest is deferred for 30 years. We see the results in the chart in the middle row. They're even a tad better than the results from the first example, because the ante is a bit cheaper for reasons that we don't have time to discuss today. But there's a possibility that the results could be even better. If at the time of wife's death, the 75/20 rate has risen from its historic low today to even 2%, that drives up the value of the intervening income interest, correspondingly drives down the value of the decedent's remainder interest. That results in a lower estate tax and therefore a better net result. Lee? Or Carlin?
Okay. So in this part of the program, we're going to talk about the gifts our clients and maybe we should be thinking about making before year end. I'll talk about why gifts this year may be a very good idea, what the possible negative outcome might be, how to protect against negative outcomes, and how to make a substantial gift without actually parting with any of your existing property. So buried within this are my two off the beaten path ideas are the advantages of giving somebody a power to give a donor a testamentary power of appointment over a trust that she's created, idea number one. Idea number two, which I'll discuss at the end, is the advantages of using what I call an intentionally defective preferred interest in an investment LLC or a family investment partnership. As to why we ought to think about making gifts this year, we're fast approaching an election which may result in a regime change in Washington, from one that's promised to keep taxes low to one who sees the need to increase taxes to meet budget deficits and to meet the needs of our countries on a social, economic, environmental level. Tax increases could have a substantial effect on the level of federal, estate, and gift taxes we and our clients pay, sometimes called these transfer taxes, and on the planning techniques that we advise our clients to use to give some protection from these taxes to their estates. So if these changes occur, they could be effective as early as January 1, 2021. And for that reason, we think action soon would be a good idea. The next slide, which says advantages of 2020 gifts, lists the things that we can do now that might not be available starting next year. So we can make up to $11.58 million worth of gifts without paying any federal gift tax. And the gifts that we make that are actually subject to gift tax are taxed at the historically very low rate of 40%. And if we live for 3 years after the gift, the effective rate is only 28.57% because we've removed the gift tax from the estate tax base. Gifts of appreciated property can be made without recognizing gain, and this is likely to change if the tax laws change to treat death as an income tax recognition event. And finally, gifts of partial interest in property can be valued for gift tax purposes using substantial valuation discounts. Gifts to grantor trusts can result in a lifelong obligation of the grantor to pay income tax on income that doesn't belong to her. And gifts to grantor retained annuity trusts, or GRATs, can be made with little or no gift tax risk or obligation. You can shift all of the post-transfer investment return above 0.4% to the grantor's family trust. All of these current features of our transfer tax system, from the very high exclusion rate to grantor retained annuity trusts, have been targeted for change by many politicians, including those now in office and those running for office. So the idea of making a gift today, gifts today, is certainly something that we should be thinking about and discussing with our clients. But on the next slide, we start to talk about the possible negative effects of current gifts. They don't always have the positive consequences hoped for. And in addition, many clients are reluctant to part with the property that's needed to make the very large 11.58 gift to use up all of the exclusion amount. So first, let's look at the potential negative effects of gifts. Gifts can backfire from a tax point of view if the gifted property declines in value, or if the gifted property is appreciated but doesn't produce a large enough post-gift investment return to offset the tax disadvantage of losing the basis step up at death. And number three, if the donor is a New York domiciliary and dies within 3 years of the gift, there are some very negative possible consequences. We're going to look at each of these potential problems more closely. So how about, we'll start with gifts that decline in value. So if the transfer tax exclusion remains the same, gifts don't actually take anything out of a donor's gross estate at all, because the value of the gifted property at the date of the gift is going to be included in the donor's estate tax base as part of her adjusted taxable gifts. The reason people make gifts to seek a transfer tax advantage is to, number one, use an exclusion that might be disappearing, and number two, because they expect that the value of the property that they give away is going to increase, and all of that increases out of the transfer tax base. But if the exclusion amount doesn't go down and the value of the gifted property goes down, we wind up with a negative result. The property is included in the gross estate, not technically in the gross estate, but it's included in the client's estate tax base as an adjusted taxable gift at the value it was on the date of the gift. And if that value was $10 million and the value of the date of death is only $1 million, obviously the client's estate is going to pay tax at that much higher rate. So one of the things we want to think about doing is how to bring it back in the gross estate if that happens. If, of course, it goes down and the exclusion actually goes down, it might still be the right result to keep it out of the gross estate, but we want to figure out how to retain the flexibility to bring it back in. Number two is the loss of the basis step up. So most property included in the decedent's gross estate receives a new income tax basis equal to fair market value at death or at the alternate valuation date. Property gifted during life doesn't receive that adjustment. A lifetime gift, as I said before, generates tax savings only on the income and appreciation that it managed to generate after the date of gift. If there's no investment return, there's no estate tax saving. So when a donor gifts appreciated property, unless the property generates a sufficient positive investment return after the gift to offset the disadvantage of the loss of the basis step up, we'll wind up with a negative tax consequence. For example, let's think about a gift of an asset worth $1 million and a basis of $500,000, and assume that it produces a post-gift investment return of 10%. Not bad. It's going to save estate taxes of $40,000, 40% of the return. But the income tax paid on the sale of the asset at 23.8% rate is going to be $142,800. If the asset hadn't been included in the donor's gross estate, there would have been no income tax. And so in this particular example, the gift cost the family $102,800. A gift of this asset would actually have to produce an investment return of about 73% to produce a break-even tax result. Finally, we all know that New York is a high tax state to live in, but it's also one of the highest tax states to die in. New York's estate tax rate can be as high as 16%, and since 2014, a New Yorker has to include in her New York gross estate the value of any gifts that she makes within 3 years of death. These gifts, though, aren't included in the federal gross estate, so as a result, it appears they will not be deductible, or the tax will not be deductible for purposes of calculating the federal estate tax. And non-deductibility will have the result of increasing the top marginal combined estate tax rate from 49.6 to 56%. So what can we do to guard against some of these possible negative consequences? We need to use look-back methods that are going to permit the reversal of gifts, the reversal of the taxability of gifts, or permitting the inclusion of gifted property in the gross estate. And this slide lists 3 methods, which we're going to talk about. Disclaimers, gifts to QTIPs, or qualified terminal interest property trusts, and the use of powers to grant donors testamentary powers over gifted property. Donors, of course, don't have to accept gifts. A donor could make a gift to, or donees don't have to accept it, and a donor can make a gift to trustees of a trust, the trust instrument of which says that if any beneficiary disclaims, the property will come back into the gross estate, will be returned to the donor. So if a disclaimer is made within 9 months of the date of the gift, Section 2519 of the tax code treats the gift as if it had never been made. So the property comes back in the gross estate it's no longer part of the adjusted taxable gifts of the donor. So if it becomes apparent, if a gift is set up this way and it becomes apparent during the 9-month period after the gift that the exclusion amount was not likely to be reduced, or that the value of the property has gone down, or any of the negative aspects that possibilities I talked about, the donor might suggest to the donee that the donee, it would be advisable for the donee to disclaim the interest in the gift. And if the donee is willing to do that, the gift is undone, it comes back. So there's a 9-month look back period to make this decision. One of the downsides of this approach is that the control over undoing the gift is not with the donor. The control is with the donee, who perhaps has an economic desire, certainly an economic advantage not to do this. In the case of a gift to a Q-tip, it's the donor that has the control. When a donor makes a gift to a trust that's eligible for Q-tip treatment, if the spouse is a U.S. citizen, the donor retains the power to decide whether the gift is going to be taxable or not. And the donor has what could be a long period of time to figure that out. The donor has until it's time to file the gift tax return, which in a case of a gift made this month isn't going to be until October of 2021. When the donor files the gift tax return, if she decides that she wants the gift to be taxable, she doesn't make the Q-tip election. If she wants it to be taxable, if she wants it to be non-taxable, she makes the Q-tip election. So if it looks as if it was not a good idea to make this taxable gift because the property went down in value or the exemption hasn't disappeared after all, then she'll make the election to make it non-taxable with the marital deduction. Finally, the power to grant the testamentary power of appointment is a way not to get the property back, not to make the initial gift non-taxable, but instead to bring it back into the gross estate. So the terms of a trust could give a person other than the donor or the beneficiary a power to give the donor a testamentary power of appointment over the trust principal, but not over income, and to revoke that power at any time. Power doesn't have to be a significant one. It can be limited to a power over the timing of trust distributions. The holder of the power to grant the power would want to give the power to the donor if it turned out that that treating the gift as excludable from the gross estate is a bad idea, with the benefit of hindsight, because the property went down in value. It looks like the donor is going to die within 3 years and lives in New York. The basis step up is more valuable than exclusion, any of the reasons that I listed before. So under those circumstances, the donor would, the power holder would exercise his power to give the donor a power of appointment. The existence of the possibility that the donor might get the power back isn't going to make the gift incomplete, and it isn't going to require the inclusion of any of the property in the gross estate unless the power is actually given. Section 2036 isn't going to apply because it doesn't apply to powers that are just over principal and not over income, and 2038 won't apply because 2038 doesn't apply to powers that are exercisable only on the occurrence of a contingency, in this case, the granting of the power, beyond the donor's control. So those are the ideas I had for sort of undoing the gift. And the next group of concepts I want to talk about is how a client can make a gift while retaining some indirect or direct interest in the property, or without actually giving up any interest in the property at all. In the first slide, the first two are conventional approaches: gifts to trusts of which the donor or spouse is a beneficiary, gift to domestic asset protection trusts where the donor actually could be a beneficiary herself. And the next two are a little bit more unusual. For a client who really doesn't want to give up anything at all, think about not giving up anything at all, but instead promising to make a gift in the future, or the creation of an intentionally defective preferred interest in an entity. A promise to make a gift is, if legally enforceable under state law, is treated as a taxable gift under federal law if it's not based on consideration, adequate consideration, or money or money's worth. Yet when you make a promise to make a gift, your net worth may go down, but you haven't given anything up yet. The trick is to how to make it enforceable. If you're in Pennsylvania, Pennsylvania permits promises to make gifts to be enforceable if they're in writing, signed by the promisor. In all other states, you need some consideration, but it doesn't have to be a whole lot. So for example, I could promise to make a gift to a trust for the benefit of my daughter if she agrees for the next year to read one good book a month. That should be enough for state law purposes to make the gift enforceable, but obviously is not money or money's worth. And so it would actually be a gift and a way for me to use up my exclusion amount without actually parting with property. The other technique is more complicated. It involves creating an investment entity in which the client acquires a preferred interest while his children or trust for their benefit acquire the common or participating interests. So long as the client's preferred interest doesn't satisfy the detailed requirements of Section 2701 of the code, the client's going to be treated as having made a gift equal to the value of what she's retained. Counterintuitive, I agree, but that happens to be the rule. So there's an example on the next slide that I can take you through quickly. The client and a trust for the benefit of her children create a limited liability company with two kinds of membership interests. The client has an interest that gives her the right to a 1% annual return on her investment, plus 1% of any additional profits, and the children's trusts have the right to everything else. Client also has the right to withdraw her investment at any time. Because the investment return that the client has retained is a non-cumulative right to the 1%, it doesn't satisfy Section 2701. So the expected results are that she's treated as having made a taxable gift of, in this example, $9.9 million at the time of the contribution. And it ought to be protected by her remaining exclusion amount up to $11.58 million. If she wants to pay a gift tax and she puts more into this investment entity than her remaining exemption, she'll pay a gift tax at a 40% rate. And if she lives 3 years, the effective rate will go down to 28.57%. The amount that she contributed is going to be available to her during her lifetime. If she needs it, she just has to exercise her rights to take it back. And if she retains the interest until death and appreciated property was put into the partnership or the limited liability company, the interest will receive a basis step up to the full initial value. And under current regulations, D is going to be able to exclude from her transfer tax base the $9.9 million in this example that she had to pay gift tax on because of Section 2701. The regulations are there to avoid paying tax twice on the same amount. It's going to be included in her gross estate, so she essentially gets to remove the adjusted taxable gift from her estate tax base. So all of the client's transfer tax goals will have been achieved so long as the property maintains at least its initial value at the time of the transaction. She's lose her exclusion, she's haven't given up her interest, and only investment returns above 1% are going to come back into her gross estate, and there's a basis step up. So that's some ideas about how to use your exclusion without losing your interest in the property or suffering some of the negative possibilities of making permanent gifts. Tim is going to tell us how to use your parents' exemption.
Thanks, Carlin. So this next topic of upstream exemption planning, it's really a supplement to what Carlin was talking about in terms of the use of these exemptions before they expire. And the idea here is to attempt to gain an income tax benefit by using a senior family member's remaining exemptions if those exemptions aren't otherwise going to be used and likely would be wasted. So here's our fact pattern. Client and her husband have already made taxable gifts, but they want to use their remaining gift and GST tax exemptions by making additional gifts of appreciated assets to trust for their descendants. Depending on the outcome of the election, they intend to do so in 2020 or early 2021. Client's mother is in her late 90s and lives in California, which is an important feature of the planning because California doesn't have a separate estate tax. Client's mother has not made any significant lifetime taxable gifts, so she has nearly all of her transfer tax exemptions remaining. Mother's net worth is not high enough to risk making taxable gifts herself. It's important, or it's possible she could live a number of years and would need our assets. However, the value of mother's estate still is well below her remaining exemptions. The dilemma, which a lot of our clients commonly face, is balancing the transfer tax planning with the income tax planning. So on the transfer tax side, the goal is to transfer appreciated assets to use up the client's gift and GST tax exemptions before they are lost due to a change in the tax law. What the clients are potentially giving up is a stepped up basis in those assets. To allow for the possibility of a basis step up, the plan would be for a client to transfer assets to an irrevocable grantor trust for her descendants. Client's gift is split with her husband, so both spouses' remaining gift and GST exemptions would be used. The initial beneficiaries of the trust would include the client's descendants and her mother. And client's mother would be given a contingent general power of appointment over the trust, exercisable at her death. So now we look at the specific terms of the proposed trust. The trustee could be authorized to make distributions to both client's descendants and client's mother under an ascertainable standard, and an independent trustee could make distributions under a broader standard. It could be also stated that the intent is to benefit descendants more than mother, so descendants would have priority with respect to distributions, it not being really the intent to distribute assets out to the mother. At mother's death, she would have a power to appoint assets to her estate or creditors, and possibly to a broader class of appointees. Mother's testamentary power of appointment would be structured as a contingent power. The trust assets would only be subject to her power to the extent that it would not result in the payment of any federal estate tax or state debt taxes by mother's estate, taking into account both the trust assets and her other assets. The extent of the power would also be limited to the amount of mother's remaining GST exemption. If mother doesn't exercise her power of appointment, any unappointed assets would be allocated to separate long-term trusts for clients' children and their descendants. If this planning is implemented, here's what we hope to expect to achieve from an estate and GST tax perspective. So let's assume mother's power of appointment is applicable at her death to the entire trust. The trust assets would be included in mother's estate for estate tax purposes. And because mother has sufficient estate tax exemption to cover her trust assets, or cover those trust assets subject to the power and her own assets, there wouldn't be any federal estate tax consequence. Since mother is a California resident, and assuming she doesn't have any property in any other states that would be subject to a state debt tax, her estate wouldn't be subject to any state estate taxes. For GST purposes, mother becomes the transferor with respect to the assets included in her estate for estate tax purposes. Assuming the assets subject to mother's power of appointment do not exceed her remaining GST exemption, mother's GST exemption will be applied to the trust assets subject to her power of appointment. The real benefit in the planning is from an income tax perspective. So assuming the trust assets included in mother's estate as a result of the power of appointment are appreciated assets, the income tax basis of those assets will be stepped up to their fair market value at mother's death. The trustee could then diversify the portfolio without gain recognition. The trust will include a substitution power, allowing the grantor to reacquire the trust assets in exchange for assets of equivalent value, which will cause the trust to be treated as a grantor trust as to the client from inception. If mother doesn't exercise her power of appointment, the client should remain the grantor of the trust for income tax purposes, even though mother becomes the transfer of the trust for transfer tax purposes. So one question might be, why are we using the client's GST exemption? Why not just have the clients use their gift tax exemption to create the new trust, preserve their own GST exemption, either for further planning if available or at their death, and then rely on mother's power of appointment to cause the trust to be a GST-exempt trust following mother's death? And the answer is, unfortunately, legislative uncertainty, and then also combined with mortality risk. So if the clients don't use their GST exemption for the new trust, and if the tax laws change before mother's death, the clients run the risk of being left with a non-exempt trust that they may not have even received a stepped-up basis in at mother's death. If the basis planning doesn't work as a result of a change in the law prior to mother's death, at least the trust would still be a good GST-exempt grantor trust going forward. And then the ongoing treatment of that trust as a grantor trust as to the client means that she may be able to substitute high basis assets in exchange for the appreciated assets at some point in the future. So again, just like our normal grantor trust planning, there may be an opportunity for basis planning, even if the use of mother's exemption doesn't pan out. Another item that we think about in trying to accomplish this planning is GRAT planning. So sometimes we can use GRAT planning as a potential way to set aside assets for this type of planning without using our clients' exemptions. The problem now, again, comes back to timing. Given what may happen with legislation, we just may not have enough time for a GRAT to mature. So the use of client's exemption and possibly the use of mother's exemption for this income tax benefit still seems to be efficient in these circumstances. And now going back to Dick.
Okay. Thank you, Tim. So the transaction that we're going to be talking about now is where a donor transfers a remainder interest in a personal residence, farm, or ranch to charity. This is not in trust, but directly to the charity. The donor retains the right to reside in the residence for life or for a term of years, after which the charity becomes the full owner of the property. And during that term, the donor continues to pay all the expenses the donor previously paid, just as if the transfer had never taken place. And under specific statutory exceptions to the non-deductibility of partial interests, the donor obtains gift tax and, importantly, income tax deductions for the value of the charitable remainder interest. Now, the statutory basis for this technique has been around forever, and it's really never been used too much. So what's the big attraction now? Well, it's the historically low 75/20 rate. Today's 0.4% means that the value of the retained life estate is worth less, and the value of the tax deductible remainder interest is worth more now than ever. Figuring the charitable deduction for this technique is not as simple, though, as just calculating the mathematical value of a straight remainder interest. You have to determine the charity's actuarial interest, which is calculated from all of the following factors: the value of the land on which the residence sits, the value of the residence itself, the useful life of the residence, the salvage value of the residence at the end of its useful life, and the donor's age at the time of the gift, and as mentioned, the 75/20 rate at the time of the gift. Before we get to how these factors play out, though, let's consider who may be a candidate for this transaction. First and foremost, it's clients who have committed to charity in their testamentary estate plans. Those clients can consider this gift a prepayment on that commitment, with the big benefit to them of obtaining a current income tax deduction that is not available for a comparable charitable gift at death. Older clients likely will find the transaction more attractive than younger clients, both because the charitable deduction is larger for older folks and because they are more likely to be able to envision and be comfortable with how the arrangement is going to play out over the balance of their lives. Like, this is the last house and we're not planning to sell it. Let's take a look at an example here. We've got Tom and Brenda, who are both age 70. Their home has been appraised at $10 million. Half the value is the structure, the other half is land. The appraiser says the house has a useful life of 35 years, after which it'll have a residual value of 20% or $1 million. Tom and Brenda transfer the remainder interest to their alma mater, retaining the right to live in the residence rent-free until the second of them dies, subject to their continuing obligation to pay the real estate taxes and all the other expenses. Based on these facts and today's 0.4% 75/20 rate, the charitable deduction is 73.2% of the current value, or $7.32 million. If the 75/20 rate from a year ago, 2.2%, applied today, the deduction would have only been $5.36 million, meaning that today the deduction has increased by over 36% since last year. Also note that if Tom and Brenda were today both 80 instead of 70, their deduction would jump from $7.32 million to $8.3 million. The second example involves a ranch where there's only land and no buildings of value. So we have Violet, also age 70, owns a cattle ranch worth $10 million. That's exclusive of minimal improvements in the cattle. Violet transfers the ranch to her alma mater, retaining the right to possession of the ranch during her lifetime. Based on these facts and today's 0.4% 75/20 rate, the charitable deduction is a whopping 94.5% of the current value. Now, this is because where only land is involved, there is no depreciation in the value of the structure that reduces the ultimate value to charity. If this gift had been made with last year's 2.2% rate, the charitable deduction would have been $7.43 million. So transacting now results in about a 27% improvement from last year. And if Violet was also 80 years old today, the deduction would be 96.7%. This next slide is just the two examples that we talked about reflected in a chart for ease of comparison. A few other fun facts about this transaction. If you've held this property for more than a year, which is typical for people with who would be interested in this transaction, there will be a gift of long-term capital gain property that's deductible up to 30% of the contribution base, which is basically AGI, with a 5-year carryover of any excess. Any personal residence of the taxpayer qualifies. So it can be a principal residence and it can be a vacation home. In applying the 75/20 rate, there's an optional 2-month look back. So you use the rate from the current month or either of the 2 preceding months, so you can select the lowest 75/20 rate in that time frame. For capital expenses, those are going to be the responsibility of the charity to the extent of its actuarial interest, but the charity likely will expect an additional charitable contribution to cover that investment. In sum, for the right situation, you've got to love the no out-of-pocket costs for an income tax charitable deduction, nothing changes scenario, except tax payments that are that would otherwise be made are back in the donor's pocket. I've got one more slide. It's unrelated, but it's just something I came across in the course of putting together this presentation, and I just couldn't leave it on the shelf. And that's if you've got assets that can live with the restrictions of the private foundation rules, then create a charitable lead annuity trust today. And that's a pretty straightforward ticket to huge future wealth transfers down a generation. The tables assume that your money is growing only at 0.4%. But if over a long period of time you can instead achieve more typical returns, all of that extra value inures to the benefit of the non-charitable beneficiaries. This works just like a GRAT, so there's no upfront gift or use of exemption. But unlike a GRAT, there is no estate inclusion if the donor dies during the term. So you can go out for a very long term. And if you do, just look at this chart to see what comes out at the end, in addition to what has been paid out to charity over the years. In short, the day you set it up, you have made a gift tax-free gift to your remaindermen of the value in the second to last row, depending on your expected return over that term. And as you see there, that's anywhere between $3 million and $7 million. Lee?
Mute on. Hello. Okay, thank you. Wow, that was incredibly stocked full of really great, valuable information, these 6 different techniques. We really learned quite a bit here. And we do have maybe 1 or 2 minutes for questions. Anybody wishes to propose any questions here? I'm trying to see if, I know that earlier we did have one relating to, this was for you, Tim, and it related to purpose trusts and whether or not they could be used to fund family meetings, if that's an option. I don't know if you want to address that issue.
Yeah, so that one, I think you probably could create a valid purpose of family education and governance. And the expenses associated with that could be paid from a purpose trust fund. And then there was a follow-up question regarding the expenses of the trust and how they'd be treated. Could they be deductible against income? I think obviously if the purpose trust were set up as a grantor trust, which it could be, then we know what the income tax results are there. The purpose trust doesn't even exist for income tax purposes. If it's set up as a non-grantor trust, or if it's created after the death of the grantor, then it would be a complex trust. I'm not sure that the expenses would be deductible. If you were to try to take a distribution deduction, that would imply that someone is benefiting from the trust, and they would probably have to pick up those deductions for income tax purposes. And so I'm kind of guessing, in all likelihood, expenses of that type would not be deductible, and the trust would just pay income tax on its income.
Okay, great, thank you. We do have another one here. This one is for you, Dick, is the 6163, the code section involved in the Gragan case.
No, I don't believe it was. In Gragan, the taxpayer had incurred a loan to pay the estate tax, and the question was whether the estate could deduct the interest on that loan. The loan was not prepayable, and so the taxpayer was, and the estate was trying to deduct all of the interest that would accrue over the term of that loan, but there wasn't a reversion involved in that case.
Okay, great. Well, we're getting to the top of the hour, and just want to thank everybody who joined for participating today in the Private Client Virtual Forum. Upon leaving the program, you will be automatically directed to our event evaluation, and we very much value your feedback and would appreciate your comments in order to continue improving our programming and deliver what is important and of interest to those who are joining. For those requesting CLE credit in New York, your code is PURPLE2. That's purple with the numeral 2, all together, no spaces. And that will be in the event evaluation form. Again, thank you for joining us. Stay safe, stay well, and if we can be helpful in any way, any of the panelists here, don't hesitate to reach out. Thank you so much.